Morning, everyone. How are you? Welcome to Offset 24/7. My name is Niharika Walia Bhatnagar, and I'm with you with the specific area of ABFM. How are we doing, everyone? Acha, first of all, a request, please share the session. Don't forget to like the session and subscribe to our channel as early as possible. Hanji, everyone. What are we talking about today? As we were discussing the module C right now, in the last class we started with the module C, so I'm just So then this is what we'll be continuing with. So I hope you're all doing fine and preparing well for the examination. If you have not started your revision batch, then kindly go ahead. Our revision batch is there on our channel. In our courses, you will find all those particular details. So please go ahead and check it out. Good morning, everyone. And what are we going to talk about today? As I already told you that we were talking about the specific area of corporate valuation. Acha, everyone, 80% discount is going on. If you're planning to purchase any of our courses, then I think you should definitely go ahead and purchase our courses right away, because this opportunity is there for a limited period, and if you purchase it right away, it would be helpful for you only, because getting it in the right time would simply ensure that you are getting the courses at the right place at the right time. So please go ahead and look out for our courses as early as possible. Okay, so let's begin with the session. Today I've got a numerical question as well. Let's see if we can cover it today or we're going to do it tomorrow. And the mini marathons are about to start as well. So please go ahead and check it out. I'll be adding more and more questions for you so that you can deal with maximum number of things for this examination and you are sorted about it. Chaliye then. When making valuations, market-based approach should not be used. Market-based approach should not be used when the size of the company is insufficient, or when the company assets are lower than the liabilities. The events that are significant and unprecedented shifts in the market price. And the next one is when it is challenging to provide accurate estimation of the realizable value in the event of going concern. But I think I would ditch the market price when the market is just unpredictable, when it's not logical, when it's not clear. So it is always better that we make things work in a proper manner, right? So that means at that point of time when market is of no use and it's of just too risky thing to do. That is what I know. So in this case, what will I do? I'll not take up market price when it is unpredictable in nature. Then the discounted cash flow method of valuation is based upon a discount for the future that is anticipated and is likely to be earned, the company's valuation, anticipated cash flow along with discount rates, or the company's potential for earnings. The discounted cash flow, everyone. The discounted cash flow method. Discounted cash flow method is, we understand there is time value of money. That's one particular thing that we understand, that is time value of money. Over the period of time, the value of money declines, right? And the reason is compounding even. If we move forward, we put money, and if we take out, then we take out the money. It's like based upon the fact, see, when you invest, you are doing compounding, right? If I put money into an FD today, I am compounding for the next 5 years. Now we reach to this situation. This is your future value. But in certain areas, what they provide you is the future value. If you have the future value, how do you come back to that particular situation today? In compounding, what do we do? P 1 plus R raised to power n. And in this case, you are going back. That means in this case, whatever your future value is, you divide it by 1 plus r raised to power n. Oopsie, sorry. I think just writing it all over again. This is future value divided by 1 plus r raised to power n. Okay? Look at this. Now in this case, what's happening exactly? In this case, they are clearly stating that when we move forward, there is a multiplication. When we move back, there is a division. So in this case, this is compounding and discounting. Based upon this, you have your anticipated cash flows along with your discount rates. Interesting now? Using the discounted cash flow valuation, everyone, what do we do in this case? They say that using the discounted cash flow valuation, which of the following is typically employed as the discounting factor? Now the point arises that we take that future value, done. We divide it by 1 plus r raised to power n. This is also done. Then what are we going to do about this? What will we do here? We will choose the cost of equity, cost of debt, annuity factor, or overall cost of capital. Somehow I find these kind of questions quite important. Acha everyone, if you haven't subscribed to our English medium channel as well, now please go ahead and subscribe the English medium channel. English medium channel has been specifically introduced for all the people who are preparing for these examination and having issues with the bilingual area, because obviously language is a certain thing where we would always want comfort when we are learning something, right? You are already into a doubt, you don't want to get to another doubt there. What do you think? चलिए then. Let's continue further. Okay, now we were talking about overall cost of capital. This is your WACC only. It's just that we don't really realize what kind of topic they're talking about. They're just saying कि देखिए, you just have to pick up the WACC, weighted average cost of capital. Then this is overall cost of capital. Overall cost of capital includes all cost of debt, cost of equity, and cost of preference shares. Then comes the present value, indicates value in use, the value of cash flows, value computed using the internal rate of return, or the present value which is buyer is willing to part with. Present value, matlab this is a situation that we are having. Once you're having a futuristic value, now you come back to your present. Matlab you are taking that particular area from the past to the present now. So that particular thing, when you're taking it up, that particular area is covered with the specific area of value in use. Present value is basically discounting of the future values. You come back from the future towards the present to make it more relevant. So the value of the cash flow is expected in future. Done everyone? Everyone, if this session is helpful for you now, please click on like there. Done. Acha, there's a case study that I've introduced, that is discounted cash flow valuation based case study. This is a scenario that you are a financial analyst, okay, analyst, and need to decide if a discounted cash flow valuation is appropriate or for a particular investment or not. Okay, whether it is correct or not, when you're looking forward to it. So everyone, the first question says, which of the following is a requirement for using a DCF valuation model? What is the basic requirement? High current cash flows. Second point is accurate forecastable future cash flows. The third is a short investment horizon or a rapidly changing risk profile. I think when we see some accurately forecastable future cash flows, accurately forecastable means that you are just very close to reality. I cannot say that I'll receive 10 rupees pakka tomorrow, right? But we can expect that we'll be receiving this much amount of money. The anticipation is there. This is about accurately forecasting. You're just forecasting. You're doing nothing else. Okay, next pointer. That is, why might investment banks and consulting firms taught the superiority of their DCF models? They talk about that specific area of superiority of DCF models. Matlab, I believe that that is because it takes the true value. Okay? Because if I say I'll receive 10,000 rupees after 10 years, I don't know what is going to be the value of those 10,000 rupees after 10 years. After 10 years is a huge time span. Na? How do you come back to the present there? Your present and your past is definitely going to be very different, right? And you need to understand there's some inflation, there are so many things that we need to consider. What do you think? So when we talk about this specific area, their model use a fundamentally different approach to valuation. Then they can customize the inputs and assumptions to better fit the investments. Customization of anything that would mean a kind of manipulation, window dressing, just to get that investment, right? The model is based upon the proprietary data not available to others, and they are trying to differentiate themselves with competitors. There's nothing doing it like that. Their basic area is all about they are trying to differentiate themselves from the competitors. Why might नहीं वैसे ना I'll go for this the reason is this one. I think I'll go for A. These models use a fundamentally different approach to valuation. Their approach to valuation and their working is definitely different. Then, so I'll go for A. Actually, everyone, as I told you, look at this specific area altogether. This is our portal. This is where you will find all our details regarding JIB and CIB promotion. Get our app. Get our app right away. You get 1% discount. You'll be looking forward towards your live classes, mock tests, and then we have the case studies and your ebooks as well. There are so many things that we have, everyone. Right? So please go ahead and check it out. Okay, so till then, just download the app, use the code Y541 and get the maximum out of it, whatever you're looking forward to. Okay? Now, if you're looking forward towards CIB or even bank promotion papers after that, certified courses are there. So I think that's the perfect time that you should look forward to. Done ji? Chaliye ji. Now comes the next point, everyone. A company has a history of paying out consistent dividends. That's one of the coolest things to happen, that you have money every single day. Done. Now what are they talking about in this case? And is expected to continue doing so. Which DCF model might be most appropriate? Adjusted present value, economic profit, residual earnings, or dividend discount model? I think I look at discounted model in a very different way. Discounted cash flow model is basically based upon what dividends we are getting. How do we look forward to it? You know? Which one's the best one? Matlab, that's actually my personal best as well, but that is this dividend discount model only. The reason is it focuses on equity. Equity are the ultimate owners of the organization. Everybody else is an outsider, right? So let's move on. The answer is dividend discount model. Hmm. चलिए. Now comes the next question. Why have some analysts moved away from dividend discount model? So this is one of the best methods, but they're saying why have they moved away? The models are too complex. The models are not accurate. The model tend to produce only conservative valuations, or the models are no longer relevant in the financial world. So the answer should be that they produce a conservative valuation. Actually, now dividend discount model has a one problem. When accuracy is there, then the things are very different, because accuracy makes things very sorted there, right? Accuracy makes things very different. But the point is, when we talk about the specific area of dividend discount model, line is just totally having a very limited horizon, just keeping it for the equity. So personally, I feel that is also good, right? Chaliye, I hope that goes well for you. Now let's move on. The dividend discount model, or the discounted cash flow model valuations they're talking about, can be categorized in the four different ways. Which of the following is not among the categories? By whether they consider dividends, by the valuation target, by the complexity of the model, or by the industry the company operates in. Dividend discount model, everyone. What's gonna be the answer, everyone? Chaliye. When we talk about the specific model, by whether they consider dividends, that is the basic thing now. Discounted cash flow model is based upon the dividends that the equity shareholders are anticipating. So it's one of the scariest part, that if if equity discount model is not working well, the dividend discount model, then the entire assumptions can fall apart. That's one particular reality about it. Right, everyone? Okay, so let's end the session here itself. But before I end the session, I hope you have gone through you have gone through our courses. So what you need to do is check out our website, that is adda247.com. That's the particular website that you should visit. The best part is, don't visit the website, download the app right away. Make sure you're getting the particular app and getting things done. Here comes the JIB and CIB. Go on to the June 2024. If you're preparing, then you can definitely look forward to the case study batches. This is what we have already added, the case study batches going on. All you need to do is, you can use the code Y541 and apply it. You will get 80% discount right away, everyone. Please make sure that you are definitely looking forward to it right away. Thank you so much for being there, everyone. Bye bye. Take care. Don't forget to use the code Wi-Fi.